You've been told banks are basically middlemen. You put your savings in, the bank lends that money out to someone else. Everyone's happy. It's the story in every economics textbook. It's also wrong. Because when a bank makes a loan, it doesn't reach into a vault and hand over someone else's savings. It creates brand new money out of nothing on the spot. And I know how that sounds, so don't take it from me. In 2014, the Bank of England quietly published a paper contradicting almost every economics textbook on the planet. Their own economists said, in plain words, that banks do not lend out the money you deposit. Banks create new money when they lend. The people who run the system admitted it in writing, and almost nobody noticed. Last time we ended on the idea that we let banks hold the pen. Today I'll show you exactly what they write with it. And stick around to the end, because the truly unsettling part isn't that banks can create money out of nothing. It's what happens when this same machine suddenly runs in reverse. This is how banks create money from nothing. Start with the story you were taught, because you have to unlearn it first. It goes like this. Sarah deposits $1,000. The bank keeps a little in reserve, lends out $900 to Dave. Dave's $900 gets deposited somewhere else. That bank lends most of that out, and round it goes. Money getting recycled through the system. Clean, intuitive, on the exam. One problem, it's not what banks do. In that story, banks are passive. They can only lend what somebody already handed them. Real banks aren't sitting around waiting for your deposit. They don't need it to make a loan. And the moment you get why, the whole thing flips inside out. Here's what really happens. You get approved for a $200,000 mortgage. The bank does not go find $200,000 of other people's savings in a drawer. It opens your account and types the number in. $200,000 that did not exist 1 second earlier now exists. That's the whole trick. The loan creates the deposit. The money is born the instant the bank lends it, as a number in your account, backed by nothing but your promise to pay it back. Sit with how strange that is. The total amount of money in the economy goes up every time a bank makes a loan. Nobody printed anything. No gold got dug up. A bank just decided you were good for it and pressed some keys. And this isn't a fringe technicality. It's the main event. More than 90% of the money in existence was never printed by any government. It was typed into being by commercial banks, one loan at a time. The cash in your wallet, a tiny sliver. Almost all money is just digital deposits spoken into existence by banks. Now the genuinely weird part. If making a loan creates money, then paying one back destroys it. Picture Dave, 3 years later, making the final payment on his car loan. He sends the bank his last $500. Feels great, owns the car outright. But that money he just paid down, it doesn't get handed to some other saver. It vanishes. Deleted from the money supply, the exact reverse of how it was made. The keystroke that created it gets untyped. Dave didn't move money, he uncreated it. So money in a modern economy isn't a fixed pile getting passed around, it's a tide. It rises when people borrow, and it falls when people repay. The entire money supply is breathing, in and out, on the total amount everyone's borrowing at any given moment. Which means how much money exists in your economy is decided by millions of private lending decisions made by banks chasing profit, not by some careful hand at the top. Remember that breathing tide. It's the whole ball game by the end. Quick one, if a capybara explaining where money actually comes from is somehow your thing, the subscribe button is the only reason this channel exists. Baron thanks you. Back to it. By now you're thinking what everyone thinks. If banks can conjure money out of nothing, why don't they conjure infinite money and buy the entire planet? Good instinct. 3 things stop them, and pay attention to the third, because it's the one that breaks in a crisis. The first break is that you spend it. The moment you use that mortgage to buy a house, the money leaves your bank and lands in the seller's bank. Now your bank owes real funds to another bank, and it has to settle up in something it can't conjure, central bank reserves. Create loans too fast, and you run short on the real settlement money, and you get punished for it. The second break is rules. After 2008, regulators forced banks to hold a cushion of genuine capital behind their loans. More money created means more cushion legally required. A hard ceiling on how fast a bank can print. And the third break, the important one, is that someone has to actually want the loan, and the bank has to believe they'll pay it back. A bank can't force money into existence if nobody's borrowing. And it won't create a loan it thinks will go bad, because an unpaid loan isn't money, it's a loss. Which sounds reassuring. Until you realize what it means when confidence disappears. Because here's the through line. When banks feel confident, they lend freely. New money floods into the economy. Businesses expand, prices rise, everything booms. Money is being created everywhere you look. but fear flips it instantly. When banks get scared, a crash, a bad quarter, a whiff of recession, they stop lending. And here's the part nobody connects. While new money stops being created, all the old loans are still being paid back, still being destroyed. Creation stops, destruction continues, and the money supply doesn't just stop growing, it can actually shrink. That's the machine in reverse. And it isn't a side effect of a financial crisis. Mechanically, it is one. The tide that filled the economy goes out, money quietly disappearing faster than it's replaced, and it drags the whole economy out with it. Money gets scarce not because anyone took it, but because the machine that makes it simply stopped, while the machine that unmakes it kept running. The same power that can conjure a boom out of keystrokes can make it vanish the same way. And almost nobody watching their savings evaporate in a downturn realizes they just watched money get uncreated in real time. So here's the corrected picture. Banks aren't vaults, and they aren't middlemen. They're money factories running on your signature, creating money when you borrow, destroying it when you repay, breathing the whole economy in and out. The strangest part isn't that this machine exists. It's that we've run our entire civilization on it and decided it was too boring to teach you. So next time someone says money doesn't grow on trees, you'll know it's stranger than that. It doesn't grow on trees. It grows on promises. And the day everyone stops making them is the day it disappears.